We've got Mr. Seth R. Freeman, Senior Managing Director at B. Riley Advisory Services, joining in live from San Francisco. Seth, hi, morning.
Good morning.
On an ongoing basis, every day you have threats of tariffs, and that has become something of a new normal. So now what else? You're looking, I guess, at the PCE data, you're looking at the latest jobless claims and the GDP print. Does that reinforce your expectation or the street's expectation that there's going to be tepid growth and possibly stubborn inflation?
Well, I can tell you one thing. It's widely believed that India as a place is chaotic and hard to predict, and we are experiencing that here. The news, constantly evolving news about tariffs, will have an effect on our economy, and with the number of layoffs that the government is imposing, may actually help the Fed achieve its unemployment goals and allow for an ironic reduction in interest rates.
Seth, good evening to you, and just wondering if this, one is this whole jobless claims print coming in at the highest for the year or the highest since October, but two, we were just talking about it in the morning that this analysis that Bank of America did of the earnings call transcripts going back all the way to 2004, showing that the sentiment for the small caps has never been as negative relative to the large caps as it has been, and this goes all the way back to 2004. We know that the Russell 2000 is down 10% as well. So is it that the US exceptionalism thus far is only the Mag 7 and the smaller companies are now really feeling the pinch?
They are feeling the pinch. A lot of the smaller companies, they have higher betas to begin with, and investors, when there's uncertainty like this, go towards larger, just larger cap companies. And we've talked about this together a few times. There is so much index-based investing now that cash coming out of small and mid caps is going to go to large cap indexes.
So we've seen over the past few sessions, Seth, the bond yields, and I'm talking about the 10-year yields, have fallen substantially. They've come to that very close to that 4.2% mark. What does that mean for investors looking at the risk-free rate, and it has been elevated at over 4.5%? So does that mean that people move out of that now from fixed income? It's not as attractive, of course, but what is the implication for flows overall?
I think it's a quagmire kind of moment because we see volatility in the market. We have uncertainty from tariffs. We have U.S. consumers have a tremendously high level of consumer debt at this time. At the same time, we're looking at unemployment rising. And so the interest rate, the return on savings and money markets and so forth is much lower, but there's a feeling of risk to go into riskier assets. And so for that reason, I don't think we're going to be seeing a lot of money, running out of relatively low risk investments that are yielding low amounts into riskier assets.